Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right. Everyone's gonna get really accustomed to us talking about life insurance every week.
I know we gotta throw in something out of left field. Like next week we're gonna talk about, I don't know.
We're gonna talk about the yen carry trade.
Let's talk about Pogs. We'll go back to the 90s.
I think that means something different now. I don't know.
Oh, that's fun.
Beanie Babies.
Yeah, there you go.
Yeah.
There you go. Who was Ty anyway?
Huh?
Who was Ty anyway?
Gotta watch the movie.
Yeah.
Then you'll know. So we are talking about life insurance today.
We are. We're going to answer a burning question.
All right.
Should you spend your cash value first or last?
Ooh.
Mm-hmm.
That is a good question. We get these sorts of questions all the time. It may not be phrased exactly like that, but most people have, I'm going to use our official term, different pots of money. And they're often a little bit perplexed on, I'm retired and I need, or it may be a hypothetical, when I retire, where do I pull the money from?
Yeah.
And is there a right way and a wrong way?
Yeah. So when I
Brandon
buy
says,
this,
there is a right way and a wrong way. No, I'm not going to tell you what it is.
Right. Exactly. If I'm going to buy this fancy life insurance policy from you, do I spend this first, or do I
right.
use other assets? And the answer, the
Drum
super
roll.
technical answer is, it depends.
It depends. Well, I was going to say there is a right answer. It's just the right answer for you, not necessarily the right answer for everyone.
Right. And look, this I think is obvious once you start thinking a little bit about it. Because if you have multiple accounts with different tax consequences to them, then the right decision for you is circumstantial, kind of depending on where you landed by the time you retired.
Yeah. Yep.
And
definitely.
The effort here is to maximize what you got.
Mm-hmm. Absolutely.
And we have a tendency of pushing against the grain just a little bit, a little bit.
Mm-hmm.
But I'll tell you that the advice, the hill we're going to die on, is, for the most part, if you got them, spend the qualified assets first.
That's very contrary, sir.
I know.
It's definitely contrary to what most people want to do.
Mm-hmm.
That's for sure.
Mm-hmm.
And I think it extends there as well. But and I'm going to present and I'm going to present the two extremes that we get. Understanding that these are the extremes, and there's a lot of middle.
Mm-hmm.
And that is, well, I am concerned about legacy. My kids, my grandkids, whatever it is. And so I don't want to leave them with a big tax burden, and I would like to leave them some money. Okay, that's one. The other is, I've done everything I can for them. And so I'm worried about doing this in the most efficient way for me. Now, there is an option 2A, which is, I don't have any kids. We have some people who are in that boat as well. So they don't have the legacy concerns per se. Mm-hmm. So I'm just using those as opposite ends of the spectrum to say the answers would likely be different for those two individuals.
Mm-hmm.
That's where the depends come from.
Yep.
No pun intended.
And look, just because you don't have kids doesn't mean you don't have intentions to leave money.
Absolutely.
Somewhere.
Of course. Yes.
So it's not a,
there could be some philanthropic.
Yep, not a definite when you say I don't have kids that we go, oh, well, you don't need any money then. Let's
right.
buy a SPIA.
No, we let people tell us. We don't lead them
Yep.
to give us one answer or the other.
Yep. So in general, if you got a healthy amount of qualified assets, our position is spend that first.
Yeah.
To elaborate on why, Well, several things. One, there are elements of the tax code that allow you to recognize a certain amount of taxable income and pay no taxes on it.
Right.
So you should do that. That should absolutely be part of the plan.
Right.
There's even a certain amount of income that you can recognize and pay a very little amount of taxes on that. So again, like do that too, because that's not a bad exchange of value.
Right.
Now,
and those are calculations your tax person can do for you.
Yes. Or if you got a little bit of analytical skills.
Yeah.
Friday night,
sure.
Easy thing to do, spreadsheet. Now, there's always going to be the individual who says, yeah, but I plan on generating $500,000 of income in retirement.
Right.
And if I do all of that as qualified money, that's going to be a lot of taxes.
Yeah.
And you are correct about that.
Yes.
At which point we would say, let's use qualified money to the degree that it makes sense. And then we'll start using the other stuff.
Right.
Now, the people as a percentage of entire population who have enough qualified funds to generate $500,000 of income in retirement, it's not many. So
I'm glad you brought up that point, because I was thinking we've never met any of those people, but we've heard they exist.
And I mean, even if you're generating something like $100,000 to $150,000 of income,
right?
If all of it's taxable, the effective tax rate on that is not huge.
Right.
It's just not.
Right.
Now, granted, everybody hates taxes. Everybody would like it to be zero. Okay, fine. But you will probably find spending those qualified assets first and letting the non to lesser taxable assets grow is a better bet from options you'll have later on, money that you will accumulate, any kind of legacy planning that you want to do or may choose you want to do because things change as you go through retirement, whatever it is.
Right.
There is a tactical benefit behind spending those qualified funds first.
And not definitely, because it depends on the ratios of what type, the balances you have in all the various types of accounts that we're talking about. Mm-hmm. But largely doing what Brandon's talking about doing will net you more spendable income over your lifetime.
Mm-hmm.
That's not a definite. There's a lot of factors that go into that, but it's likely.
A lot of this is to kind of nudge you in the direction of where you should start thinking.
Yeah.
So
it's more to just get you to not accept a rote answer and to actually explore it for yourself.
Yep. Now, one other thing to keep in mind specific to life insurance, and especially true of whole life insurance, pretty marginally true of index universal life insurance. These products do tend to gain greater efficiency as time goes on.
Right.
So the accumulation or the accumulation of benefits grows as it ages.
Yep.
So spending your qualified assets first allows you to take advantage of parts of the tax code that will make the taxability of that less. It draws down the balances that you'll be forced to take out when you reach the age of RMDs.
Right.
And it also allows you to maximize the efficiency that's constantly growing with the life insurance policy because you're not yet starting to encumber that with withdrawals or loans.
Right. Yeah.
So there's a number of things that you are taking advantage of.
Yep. You're giving the cash value a little more time to compound, mm-hmm. which is absolutely going to help.
Now, there's a group of people out there who will say, yeah, but I don't have much for qualified assets. What do I do? And to those people, I would tell you, now it's time to start thinking about using the life insurance policy early, more seriously.
Right.
With an additional strategy in mind, which is very likely that you may well choose to use some of those other assets that are, let's say, Roth assets or just general brokerage assets as a move to life insurance at some point later in retirement. And we've talked about this on previous podcast episodes, a sort of de-risking strategy that you use in complement to life insurance. So what you're doing is taking loans, for the most part,
from the
as
policy.
an income source from the policy.
Yeah. Right.
And then as time goes on, you'll take distributions from other assets. Roth would be most ideal, but also doable with brokerage where you're typically incurring capital gains, tax liability. And you're going to repay loans on the life insurance policy. And the reason you do this is you know that you're going to make available again certain cash that's in the life insurance policy. You also know that there is a guarantee to near guarantee of growth that's going to take place in the life insurance policy.
Right.
So by virtue of selling out of certain positions and moving it into life insurance, all you're doing is effectively rebalancing risk.
Right.
But you're doing it in concert with a product that has, one, much higher guarantees on the low risk side of the seesaw than a number of other assets that you could buy, like bonds, for example.
Sure.
You also get very high tax preferential treatment in the sense that you can move from one area to another. So let's say you've got a Roth that's got a lot of S&P 500 index exposure. It's gone well, but you've kind of decided, okay, at this late stage in life, probably shouldn't be exposed to something that could go down 20%.
Right.
At least not to the degree that I am right now. So I'm going to sell some of that and use it to pay off loans in the whole life policy, which will make more cash available in the whole life policy.
Yep.
And also ensure that I'm accumulating value.
Mm-hmm. Mm-hmm.
That we have shown creates a greater amount of cash available to you. It also creates more legacy value because it creates more death benefit available by virtue of doing that.
Right. Two birds, one stone, all that stuff.
Again, ideal Roth money, because then there is zero tax consideration. Doable even when it comes to capital gains tax, but we got to be careful about the type of capital gain that we are potentially recognizing.
Sure.
So if far less qualified money is part of your portfolio, then yeah, you may very well use the life insurance policy first.
Mm-hmm.
With the likely intention that you will kind of transition money to the life insurance policy later on.
Yeah.
Now, those are kind of two extremes because most people don't have, well, a decent number of people have like 90% of their retirement assets in qualified funds. Not that many people have 90% in Roth funds.
No. I was going to say we see far more situations where people have the vast majority of their liquid net worth is in 401k / rollover IRA. So
yep, and
all pre-tax, meaning they're going to pay taxes when the money.
Yeah. Well, some of them may be making Roth contributions now, but that's a newer-ish feature that was not available when they started, and even if it became available kind of midway through, they didn't adopt it for whatever reason, and they've continued to make use of saving money in qualified funds.
Right.
Now, there's also going to be a group of people out there who have a much more even spread. They've got Roth money, they've got qualified money, and really they've spent more time than average thinking about income sources in a diversified way.
Mm-hmm. Mm-hmm.
So maybe they own brokerage, or maybe they have a brokerage account where they've done a decent amount of income style investing already.
Right.
And they know that, the brokerage account is going to generate X amount of dollars in distributions from whatever type of assets I decided to buy.
Mm-hmm.
Perhaps they bought an annuity and they intend to start that at retirement for some additional income. In those situations, life insurance likely plays a role in the necessary income category.
Right.
It's kind of a fill-up asset for income in that case. What I mean by that is, let's say that you decide that when you retire, you're going to need something like $12,000 in like income for absolute necessities
per month.
Yep. and you sit down and figure out that, okay, with Social Security and let's say you bought an annuity and let's say you're part of an old pension plan, that's all going to come out to like $7,000 in income.
Right.
Which is great. You got a good percentage of this $12,000 need covered.
Yep.
But you've also got an additional $5,000 that you need to come up with to cover your necessary income amount.
Yep. Exactly.
So this is where we see life insurance coming into play. And I want to be clear about this. Let's say you look at your life insurance policy and your life insurance policy is totally capable of generating something like $30,000 a year in income.
Mm-hmm.
That's cool. Take $5,000. Or excuse me, I said that wrong. Could generate something way in excess of your $5,000 a month income requirement. Like,
yeah, the need to fill that gap there.
Yeah, it could generate like $10,000 a month easily.
Right.
For you. Don't do that. Just use the $5,000 that you need to fill in that gap.
Right.
And then when it comes to discretionary spending, sell some assets somewhere and use that.
Right.
That would be, in our eyes, the ideal way to execute the income strategy with life insurance.
Mm-hmm.
Life insurance doesn't have all the guarantees that an annuity would have, or even Social Security has, but it's very, very close.
Right.
And for that reason, we feel it can work really well, especially if we're not at the maximum producible capacity of the life insurance
the thing
policy.
is, it doesn't have income guarantees. It just has an incredibly stable growth, which thereby makes the income much more reliable.
Yes. And the other cool thing in this scenario, if we're using it to cover in or to cover the unmet part of your necessary income, but we're not using the maximum capacity of what the life insurance could produce, this gives you a lot of options as time goes on.
Yeah.
So necessary expenses will probably increase over the time of your retirement.
Right.
And you could either use the assets that are more for discretionary spending, or because you're not maxed out on the life insurance income capabilities, you just increase it.
Yep.
And if you're not maxed out on the life insurance capabilities, the chances that is going to grow at a rate far in excess of inflation are very, very high.
Yeah. Yep.
Now,
is that all we're done?
Well, we should address one question, which is there are going to be people who say, oh, so what you're telling me is life insurance is good, but it's not good enough to be like my 100%. I want all my income coming from life insurance.
Mm-hmm.
I'm not saying that. It could. I just don't think that's going to be realistic for most people.
Yeah. I don't know that we've ever known anyone who was in that camp. I mean, we know some people where it's a significant amount.
Yep.
Now, what's significant to one may not be significant to another. But I don't know that I've ever. For most people, it would require you getting a lot of after-tax money into a policy for quite a while.
Yep.
And most people, and this is not a judgment, it's just a fact. Most people don't hit their highest earning years until they're well into their 40s, which doesn't give them a whole lot of time to stuff a life insurance policy full of money.
Yep.
There are exceptions, obviously, but
yep.
It's not that life insurance can't work to deliver a large income stream later in life. It's just that there's no magic to it. As we've said many, many times, if someone asks, how do I get $1 million of cash value in my policy? It's like, well, you got to pay premiums of something more than $1 million over whatever period of time.
Yep.
But that's absolutely the case. So no magic.
Nope, there isn't. Now, another question that has come up and been a reality in some people's cases They buy life insurance. It's part of the income plan. They get to retirement. Something happened, whatever it was, that went extraordinarily well for them.
Yep. Mm-hmm.
And they say, I don't really need the life insurance for income.
Yeah.
What should I do now? And honestly, and this is going to sound a little bizarre, I think you should at that point start using the life insurance policy for any kind of discretionary expense that you have.
Yeah.
If you want to go on vacation, go on vacation. If you want to do a renovation, do a renovation. And I would also coordinate that with other assets. Again, Roth or certain brokerage, depending on tax implication, as a repayment when it makes sense. And the reason I say all of this is life insurance does not care what is going on with the broader economy. You are not going to have to worry about whether or not now is a good time to take a loan from a life insurance policy.
Yep.
Because it's unaffected by all that stuff.
Yep.
So you can use the life insurance policy for discretionary expenses and then use the other assets when timing works out.
Yeah.
So now you're not worried about, well, we need to buy a new car. But there's a lot of discussion about what the Fed's doing or what the current president's doing or what this policy might do to our holdings. Or there was just a correction in the market and we lost some money. So I'd rather not sell right now because I'd like to recoup that. And none of that has to happen.
Right.
You just take the loan from the life insurance policy,
get the
buy
car.
the car, then you wait for whatever you're waiting for to happen inside your portfolio and sell it and pay back the loan. That's
right.
Super easy.
That's an option. Yeah.
It makes the timing issue far, far less of a headache.
Yeah. I agree.
So if you're in the very enviable position of simply not needing the life insurance to generate any of your income, then at that point, for sure, use it as a discretionary income source because you'll never have to worry about if now is a good or bad time to use this money.
Yeah. Agreed.
It's just unaffected.
There's any number of things you could do, but
now we should also address because people are going to ask, like, are you talking about whole life insurance? Talking about indexed universal life insurance? Yes.
Yes.
This works for both.
Yeah. It does.
The only one that this wouldn't be true for is variable universal life insurance because their timing matters.
Right.
But whole life insurance, indexed universal life insurance, all of what we have just spent the past 20 plus minutes talking about is true. And so there isn't one that is going to be better than the other universally for any of what we just ran through. And whether you own whole life insurance or indexed universal life insurance, all of these same principles apply. So it's not going to be the case that because you bought whole life insurance, you should actually spend that first or last versus if you bought indexed universal life insurance. No. Don't worry about product type. These rules apply equally.
Yep. That is absolutely true.
So it is circumstantial, but there are some broad guidelines you can follow to get this correct as defined by as really trying to maximize what you'll accomplish with the assets that you've accumulated.
That's right. I agree.
Life insurance makes a great complement.
It certainly does. Nothing like a pool of capital that, as long as you manage it correctly, is not taxable. So
yeah.
It gives you a lot of flexibility.
Mm-hmm. Anything else?
No, I don't have anything else.
All right. It can be a short one today. I am Brandon Roberts.
And I am Brantley Whitley.
Thanks so much for joining us, and we will see you next week.